Let's connect with Amit Sachdeva, India Equity Strategist with HSBC Securities and Capital Markets. Amit, thank you for joining us. Let's start with your view on the market per se. It's turning out to be a good year. Even the FI flows have been slightly indifferent. The markets are rising up because of local flows and liquidity. Do you think we're headed higher, or in the near term we could run into some resistance?
Our view on the market for overall, as I had discussed earlier as well, we are overweight on Indian market. We stay quite constructive on Indian market. The reason for that is that India's macro construct to earning construct to even external construct, even valuation, I would argue, is more tenable. And it rarely happens that that phase sets in and stays for this long a time. And our view is that the phase sets in, it doesn't go away. It has reasonably longevity. I would hazard it's 3 to 5 years even. So we are somewhere in the middle, that the view we have been holding on for a while. And I think in this phases, you will see zone excesses. We've seen mid-cap rallies, small-cap rallies, and then some consolidation. But eventually, that consolidation phases are very shallow. We've seen, for example, January and February, we've seen about 3 billion outflow by FIs, but it was quite, inconsequential because domestic flows are very strong and market was barely flattish. And now in March, we've seen 4 billion flows have come in from FIs, domestic flows in stock markets are 4%. And April again has been a bit of a weaker start. We have seen FI outflow because of the geopolitical risk and wavering expectations of US bond yields and factors like that. And even China rebound were to happen, then somebody may argue that would that be a risk for India? So there's several factors shaping investment case of India in the short run, creating a lot of noise. But at the same time, we argue that the structural momentum that has got set for India is here to stay. And that's the reason we maintain a little bit of positive bias in India. It remains an overweight market for us. And that's where we are, Nikunj.
For the longest time, everyone has said the following, which is that India is a great story to be in. The economic contours are in place, but valuations which is a concern. Could you throw more light on it? That if one is looking at projected returns from these levels, where multiples are above the historical averages, what should one expect in terms of 2 to 3 year returns?
Okay, Nikunj, obviously this is a question which is always present for Indian market. It's not just today. If you go back 1 year, we would have the same debate. But I would say let's understand valuation from few benchmarks point of view. And that makes it easier where we are. When obviously at index level, things look much more palatable, but there's excess on one side and depression on one side. But let's put some numbers in context. Like if you look at a bit of a crisis like valuation for India, that is about 11, 12, 1 year forward PE. And if you could look at 5 year average is about 19, 20 now. And if you look at a bit of a depressed valuation for India when things have really gotten bad, macro is bad and earnings have misses, we bottom out about 16, 17 the current time. We are at about 21 times, right? It's about 7-8% premium to, it's 5 year average. But I would argue that India's structural investment case has risen in the last 3-4 years. Earning growth has been very resilient. One of the things we really ignore is that how reasonable the inflation expectations have been, which has been a part of problem for India. Inflation trajectory has been much more stable. GDP growth rate stands out, and also even in a context where fiscal is also consolidating, rupee is going to be stable. We don't get that context. So if there is some premium to past, it is not. I would argue that it's not a very large premium, and hence you may experience some events which impacting India's valuation a little bit, and that's the reason those phases are very shallow. So although valuation at some level has its own excesses, but at the market level, I would argue that it doesn't have as much fluff as people would imagine. So in that context, small corrections become a good window where FI flows return and market again rebounds back. So that phase we are in. We are in a volatile market. We have so many unknowns. So we expect phases of consolidation to reappear again and again. FI flows turn negative on a daily basis, for example. But at the same time, that position reverses also very quickly. And as how earnings shape up, that would shape the market, to answer your question as well. Multiples are here to stay. Multiple can expand also a bit. But I think the good part is that earning expectation that we have, for example, FY25, it's about 15 odd percent, 14, 15 odd percent. I would hazard a guess that, it's much more credible how the earnings are shaping up. So if the earning downgrade risks are lower, I would say that one could expect that multiples to rotate very easily, and at least earnings should compound into the stock returns as well.
Curious to know what are your sectoral underweights and overweights at this juncture?
So, it's a great question because, so for example, if I were to look at some of the sectors we like, some of the sectors we like are, for example, specialty retail, right? Wherein we see, great momentum, great earning growth, and also some sort of momentum is, earning and operating outlook. Even FI flows, if you look at, they are disproportionately favoring, for example, that sector as well. Hotels is part of that, by the way, travel, luxury retail, etc. So that space is very exciting to us. Auto is also something we are very positive. Industrial space, we are very positive. We also like, for example, even telecoms as a sector which stands out in our sort of framework. What we also see, healthcare is well placed for now. It may have its periods of bit of consolidation, but healthcare continues to be well placed. What we, for example, see two sectors as a risk-on sector, where banks sits, for example, wherein operating outlook is a bit challenged because NIM pressure and all those debates will continue. But I think it has slipped to, for example, in our framework, slipped to a zone where we call risk-on zone. And I think whereas the business dynamics even give a semblance of improvement, stocks will experience reasonable rallies there as well. So banks is something we are positive. Even selectively, I would argue although revenue growth outlook for IT sector is quite still challenged, but at the same time, that sector also stays in this bucket. Marginal improvement there would also spring up as a surprise. We continue to be a little cautious on FMCG names. So we have been cautious since September last year. We continue to maintain that caution because the demand outlook is a bit uncertain. Valuations are reflective of the past. So we see some sort of rebalancing happening there. But overall, that's the kind of contours we are on the sectors.
Outlook when it comes to the broader markets in terms of what the investors' approach should be. Do you believe that valuations here looking a little bit lofty? Is there a further, downside that's expected? And how should investors use the opportunity within the broader markets?
See, our view is that valuation at the aggregate levels are tenable. It's not that out of whack. What could be out of whack could be pockets of it. And one should definitely in this market, one should avoid those excesses. For example, if you recall in December, we were cautioning that one should be cautious about mid and small cap. And because the excessiveness was built in there. Now, after Jan and February correction, small cap, we see large correction. People were building a scenario where 2018 kind of sell-off can happen. And we argued, no, we are not in 2018, for example. We will have some sell-off, but I think rebounds will be equally sharper. So I think one has to look for this, good quality names where the earnings are very good, or certain laggards which have lost momentum because of temporary factors. So we see two kinds of strategies work out in this way. One, buy where the growth is quite robust. Second, where I would say the laggardness is built in, and usually we are dealing with good quality companies and all those things, and in sectors which we think are favorable, one can look at for those laggardness as well to balance that risk. And that's the way we will approach this market. And we should expect some consolidation, some rebounds, but on an average, a positive year. But we don't expect kind of bull runs of last 3 years, 2, 3 years that we've seen. That would not reflect in the same momentum, but it's still, I think, a construct should be positive.
Okay. I'd like to draw your attention to the importance of elections. There is a view that a lot of flows will come back into India, especially global flows, once the election verdict is out. Do you buy this argument? Do you think that there is a money waiting on sidelines and really the long-term guys will only come after the election cycle is over?
I think elections are obviously an event. Market discounts a little too early. And I would say there's a general consensus of continuity, right? If you were to, but at the same time, unless there's a major surprise, I don't think so that should decisively change anything, for example. Although I would probably hazard that if market has rallied before that, you might even see a surprise consolidation happening for a short time before, again, market rallies. But at the same time, market would definitely surprise us. if you look at last 3-4 cycles of elections, you've seen regardless, post-election, a consolidation phase emerges, and market would surprise you by the timing of it. So some amount of risk tolerance as market has at that point in time, one should not rule out even in a favorable outcome. Market will surprise you with the less consolidate and then reassess the risk for India and then what's happening to China in the meantime as well. So a lot of events have to watch out for. My sense is that election should not be viewed as and a catalyst to sort of get into India, for example. I think that trade is probably not existing.
So then why are FIs selling out? I mean, if one really looks at the global setup, US is in a mess. China, nobody knows what is happening. Good, bad, ugly, frankly, no one knows. And if you are a global allocator, last 4-5 years, you've lost money in China. So you don't want to go there.
Sure.
Europe, it's a toss of coin whether it's a dead man or a sick man. I can argue endlessly. So if everything in the world is looking so polarized and when growth is declining and decaying, India is the only growth frontier. If it is so easy to understand, why is that FIs are not coming to India aggressively?
In fact, Nikunj, you have to look at FI flows from a 12-month view rather than just 1 month view, right? Last year, we had about 21 billion of inflow, right? And this, after basically January to March, was quite an outflow for FI point of view. So that was a great last year. Now we have only seen January and February, 2 months of only minus 3 billion outflow, which is hardly an outflow. And we have seen March again 4 billion of inflow. So it's unfair to say that FIs are not coming, number one. Number two is how decisively they should come. I feel that market has tolerance for certain amount of flows before it becomes overheated. And one wants to also avoid and take risk elsewhere as well when you are seeing some valuations getting overheated. And that, that measurement continues to happen in the market. So I would say that if last year kind of flows come into India, 21, 22, market has now tolerance to absorb that flows without really getting overheated. But say, for example, in a very short period of time, 15, 20 billion flows come in, and that would also trigger a lot of momentum from domestic flows as well. And then market tends to discover pockets of excessiveness, weakness, and then markets want to avoid that free fall as well, and hence some consolidation phases just to avoid any downside risk start to happen. So that will continue. But my sense is to say that FIs are not coming is probably I would say is too short-termist a view.
Where are you really excited about in terms of picking up a sub-trend within the manufacturing? Are you excited on capital goods? Are you excited on EMS? Are you excited on solar plus renewable? What within manufacturing looks good to you?
So look, what we are excited about is the path of manufacturing-led growth India is taking for next 10 years. So obviously there will be various pockets of it. And we also are electronic manufacturing, we have some key overweights. We're also excited about renewables. We're also excited. We don't have a relative ranking here, but I'm sure that once the government is formed, and there'll be a whole lot of revisit of PLI structures and all those things. But that theme, Nikunj, is here to stay. And I think small to mid and large caps will continue to benefit and play those thematics over the years. So I would probably not go into ranking what we like, but we definitely like manufacturing as a theme quite a lot. And some of our stock picks we have across sectors reflect that sort of thinking as well.
Right. Okay, Amit, great to have you on the show. Thank you so much for taking the time out and speaking with us.
Thank you so much. Have a great day.